Knowledge is like a treasure trove, and practice is the key to unlocking this treasure trove. Hello, I am your speaker Neerav Shah, and welcome to the Jambi Research Institute Stock Market Training class. First, congratulations to the students who successfully subscribed for the IPO today. So, now we will take a look at today's index. Sensex ends 260 points higher, Nifty above 22,000. BSE mid cap, small cap up 0.8% each. Nifty metal led gains up 1.5% with FMCG, auto and pharma following at 1% each. Nifty IT led losses down 0.8%, trailed by Nifty Realty and Nifty PSU Bank, both down 0.4% and 0.3% respectively. India's benchmark Sensex surged over 260 points while Nifty ended about 22,000 mark on May 10, tracking gains in the global equity markets. Now we will talk about IPO's offer price and range. ABS Marine Services Limited 140 to 147 rupees. Premier Road Lines Limited 63 to 67 rupees. Aztec Fluids and Machinery Limited 63 to 67 rupees. Biotex Industries Limited 94 rupees. Energy Mission Machineries India Limited 131 to 138 rupees. Aadhar Housing Finance Limited 300 to 315 rupees. TBO Tech Limited 875 to 920 rupees. TGIF Agribusiness Limited 93 rupees. Silk Flax Polymers India Limited 52 rupees. Also, I will tell you about indices overview, index name, percentage change. Nifty Bank minus 0.14% change. Nifty IT minus 0.82% change. Nifty Auto Nifty Auto 0.94% change. Nifty 50 0.44% change. Nifty Pharma 0.94% change. Also, we will talk about industry index. Banks, IT software, cement and construction all are fall, and diversified power, FMCG, pharmaceuticals, NBFC, auto, financial services, gas and petroleum, metal and ferrous, telecommunications, engineering, auto ancillaries, consumer durables, defense and tobacco all are rise. And real estate, no change. So that's the general news for today. Now, Jambi's Wealthstorm plan has been a huge success with profits exceeding 100% for those who followed all instructions. Congratulations to all like-minded friends for reaping the rewards of their wise choices. The first phase is now complete, and we are moving into the second phase, aiming for our 280% profit target. It's essential that everyone strictly adheres to all instructions to maximize their benefits. Yesterday, we learned about when to increase or decrease our investments. Now, it's time for everyone to understand the concept of an investment portfolio. Portfolio management refers to the management of assets by investment managers according to their principles of portfolio theory. This involves diversifying assets to spread risk and improve investment efficiency. Generally, asset portfolio management can be categorized into three main types: static, dynamic and hybrid. Let me provide a brief overview for you reference. Point number 1, static portfolio management. Static portfolio management refers to investors holding stocks from different risk categories in fixed proportions which do not change with market fluctuations. Static portfolio management means that the allocation of funds to stocks from different risk categories remains fixed over time. It doesn't imply that the proportion of funds invested in bull or bear markets stay the same. For example, a conservative investors might allocate 50% of their funds to buy both low risk, low return and high risk, high return stocks when opportunities arise. They may allocate 35% of their funds to low risk stocks and 15% to high risk stocks initially and maintain this ratio in future allocations. Conversely, a more aggressive investors may reverse this allocation with 35% of funds going to high risk stocks and 15% to low risk stocks, consistently following this distribution ratio. The advantages of static fund management is its simplicity, but it's rigid and may not be optimized capital efficiency. In situations where market trends align with investors' expectations, static fund management can yield good results. However, if market trends diverge from expectations, it can increase losses or decrease returns. Now we will talk about the second point, dynamic portfolio management. Dynamic portfolio management means that the allocation of funds in the portfolio changes with market fluctuations, with a larger proportion of funds chasing market hotspots. Compared to the index, aggressive portfolios exhibit greater volatility than conservative ones. The more aggressive the portfolio, the greater the deviation from the index. Conservative portfolios typically move in sync with the market with smaller deviations. The advantage of dynamic fund management is that it fully utilizes funds to attain maximum returns. However, its drawback is that it requires investors to have high investment skills. If the dynamic management pace is inappropriate, it may result in significant losses instead. In a bull market, aggressive portfolios tend to outperform both the index and conservative portfolios by a significant margin. However, during bear markets, aggressive portfolios experience larger declines compared to the index and conservative portfolios. Therefore, in dynamic fund management, it's important to gauge changes in the index trend. During periods of market risk, adopting a conservative investment strategy is advisable, while during bull markets, a more aggressive approach is warranted. Dynamic fund management also involves sector rotation in the market. During market operation, not all sectors rise or fall simultaneously. Instead, there is a phenomenon known as sector rotation. This phenomenon is more common during bull markets. Third point, hybrid portfolio management. This management approach combines both methods mentioned earlier. A portion of the funds can be allocated for long-term investments in a static portfolio, while another portion can be used for short to medium term investments in a dynamic portfolio. After understanding the three models of portfolio management, we would like to share with you a fund allocation technique called the constant proportion portfolio insurance method. The short form is CPPI. The constant proportion portfolio insurance method involves dividing investment funds into two parts. A protective portion, mainly composed of a low risk and stable price bonds, and an aggressive portion, primarily consisting of actively traded bullish stocks. The allocation between bonds and stocks depends on the investor's goals. If the investor aims to maintain correct income, the proportion of the protective portion in the total investment should be greater than that of the aggressive portion. Conversely, if the goal is to increase the total capital, the proportion of stocks in the total investment should be greater than that of bonds. Once the ratio between stocks and bonds is determined, the investors continuously buys or sells stocks to maintain this fixed ratio as the value of stock fluctuates. If the market value of stocks rises, a certain amount of stocks is sold and bonds are bought. Conversely, if stock price decline, some bonds are sold and stocks are bought. For example, let's say an investor allocates 1 lakh rupees to the stock market with a predetermined ratio of investment in bonds and stocks at 1:1. They also decide to buy or sell stocks whenever their price changes by 10% in order to maintain the original ratio. If the stock price rises by 6%, making the total market value of stocks 55,000 rupees, assuming bond prices remain unchanged at 50,000 rupees, the investors' total funds became 1,05,000. The ratio of stocks to bonds in their portfolio also changes to 52.4% to 47.6%. To maintain the 1:1 ratio, the investor sells half of the 5,000 rupees profit from stocks, meaning they sell 2,500 rupees worth of stocks and use that money to buy bonds. If the stock price falls by 10%, making the total market value of stocks 45,000, while bond prices remains at 50,000 rupees, the ratio of stocks to bonds become 47.6% to 52.4%. To maintain the 1:1 ratio, the investor needs to sell 2,500 rupees worth of bonds and buy an equivalent amount of stocks. Although adopting the constant proportion portfolio insurance method may seem conservative and lacking flexibility, it can effectively adapt to market fluctuations by buying low and selling high, which is a fundamental principle for success in the stock market. It maintains a balance between stability and responsiveness to market movements. However, it's crucial to choose suitable investment targets when employing this strategy. Alright, many friends have shown interest in learning about the methods used by institutional investors to build position in the market. Responding to this demand, we have compiled a list of common strategies employed by institutional investors for building positions, and we are happy to share them with everyone. Investors who have been in the stock market for some time understand that following institutional investors' actions can lead to profits. However, institutional investors often use various tactics, such as throwing out misleading orders, to conceal their activities from smaller investors, making it challenging for them to follow institutional strategies. Below, we will share 8 common methods that institutional investors often use for building positions. Suppression accumulation method. Investors are aware that after institutional investors unload their positions in a stock, there typically occur several significant downward movements. However, after a stock experiences a decline, it once again becomes a conducive to institutional accumulation. At this point, whether it's the previous institutional investors reaccumulating shares after unloading or new institutional investors entering the scene, they will enter the market before the stock hits its bottom and continuously suppress the stock price using the shares they hold, causing the stock price to consistently reach new lows. At this stage, small investors and retail traders often have unstable mindsets. If combined with negative news, most investors cannot resist the urge to cut their losses and exit. Institutional investors then capitalize on this by buying the stocks that these investors sell, thus accumulating positions. The longer the duration of the bottoming process, the more shares institutional investors collect. Typically, only institutional investors with substantial funds option for this accumulation method, and they must ensure strict confidentiality. Otherwise, if another institutional investor intervenes and buy in during the suppression of the stock price, the efforts made in the initial stages will be wasted. So here's the next point. Rebound accumulation. During rebound accumulation, institutional investors capitalize on people's physiological tendencies to sell high and buy low, sell on rebounds and reduce positions on rebounds. It's a method of building position that is relatively time efficient. So, when the stock price drops us to a certain low level, even though institutional investors already have a certain amount of shares, they are still far from their target. To encourage more investors to sell off their floating shares, institutional investors typically use their funds and shares to create periodic rebounds, followed by suppressing the stock price again. By repeating this process several times, they instill a mindset in retail and small investors that they can sell the stock at a certain price level and then buy back at the bottom. Once institutional investors accumulate enough shares, they create another rebound. However, when most investors sell off their stocks, institutional investors stop suppressing the stock price and start raising it instead. Institutional investors using this method of accumulation are easier to identify compared to those using suppression accumulation because they often leave patterns like double bottoms or compound head and shoulders on the candlestick chart. With careful analysis, it's not difficult to identify institutional investors. Bulldozer method. When institutional investors use this method of accumulation, there are usually clear signs on the candlestick chart. From the candlestick chart, The price trend alternates between bullish and bearish candles. After a bearish candle, a bullish candle appears, followed by 2 to 3 bearish candles and then 2 to 3 bullish candles, while the stock price gradually rises. Because the stock price often isn't at historical lows when using the accumulation method, it's challenging for investors to determine whether institutional investors are accumulating or distributing shares. Therefore, this method of accumulation is relatively discreet. Here is the next point: stormy accumulation. Generally, institutional investors have only adopted this method of rapidly accumulating shares regardless of cost when they receive positive stimuli from the index or anticipate significant positive news. When there is a boost from positive news and the market is on the verge of reversing, institutional investors resort to this method to accumulate shares swiftly and attract more capital. This method is more commonly used in the Indian market. Typically, it results in daily volume surge and upward trends, while many retail and small investors are selling their stocks. Institutional investors are aggressively buying. As a result, when the market is near a significant increase, many institutional investors secure substantial gains. So here's the next point: continuous surge method. The continuous surge method is commonly used by institutional investors when targeting less popular stocks. Unlike other methods that involve spending time accumulating shares at the bottom, this method involves continuously pushing up the stock price to quickly complete accumulation. Less popular stocks often fail to rise even when the index goes up and tend to follow the index when it falls, causing headaches for investors who are stuck. Therefore, when these stocks start to rise, investors tend to sell their shares to get out quickly, allowing institutional investors to easily collect a large number of shares. So, next point: false bottom break market. The false bottom break market occurs when institutional investors, after accumulating shares for a certain period at the bottom, still haven't gathered enough shares. To expedite the accumulation process, they further suppresses the stock price at any cost, pushing it to new lows and triggering panic selling in the market. Institutional investors then take advantage of this panic to buy at low prices. Subsequently, they raise the price again, creating a false rebound, which continues to induce investors to sell off their shares in large quantities. Next point: contrarian accumulation method. Generally, fewer institutional investors option for this accumulation method because many investors understand that going with trend in the stock market is more profitable. Therefore, institutional investors using this method usually choose stocks with good fundamentals or potential themes to accumulate shares. Since it's going against the trend, institutional investors can acquire shares more easily. Additionally, contrarian speculation is more likely to attract attention in the market, drawing more investors to participate. Consequently, there are more distribution opportunities in the future. The contrarian accumulation method mainly comprises two types. First type: contrarian market method. When the index experiences a downturn due to negative factors or other reasons, institutional investors select promising individual stocks and accumulate shares against the market trend. And the second point: contrarian stock method. Institutional investors accumulate shares against the prevailing trend when individual stocks experience significant declines due to negative factors or sharp sell-offs. So next point, uniform accumulation method. The uniform accumulation method is commonly observed in a small cap and newly listed stock because typically the cost of new stocks is relatively low. When the price reaches a certain level, holders tend to sell, enabling institutional investors to accumulate sufficient shares easily. Additionally, because the risk of accumulating shares in new stocks is relatively low, institutional investors are more likely to be attracted to them. Have you learned about the common and accumulation methods used by institutional investors? Next, I will briefly explain this intrinsic relationship between funds management and stop loss and take profit strategies. Stop loss and take profit strategies primarily focus on operational methods and techniques. These techniques should revolve around fund management. Fund management refers to controlling investment risk through financial management, making it a more comprehensive, direct and effective risk control method. It's a management approach rather than an operational technique. In other words, a fund management plan should be established first, and then stop loss and take profit criteria can be formulated accordingly. The market always carries risk, and even if the analysis indicates a low probability or extent of loss, risk persists. Fund management must consider the minimum loss ratio, or what we call the loss reserve. The loss reserve refers to the funds set aside for potential losses in trading, and it's closely related to market risk, position size and stop loss strategies. The greater the market risk, the larger the position size and the looser the stop loss strategy, the more loss reserve is needed. In situations where the loss reserve remains constant, in markets with relatively higher risk, the required investment should decrease and stop loss policies should be stricter accordingly. Profit in stock market investments is achieved through fund management. During this investment process, fund management is accomplished by controlling overall position size and portfolio allocation. Ultimately, controlling position size is achieved through trading methods such as buying and selling. In the stock market, there is a saying that goes, "Those who know when to buy are apprentices, and those who know when to sell are masters." This saying summarizes investors' experience, implying that investors feel less pressure when they are not holding stocks, allowing them to keep a clear mind. However, once they buy stocks, they become anxious about when to exit, leading to emotional ups and downs or significant losses. The fundamental reason for this phenomenon is the lack of effective fund management methods. Fund management is the core of stock market investment, and all trades should revolve around this core. Fund management serves as the framework while trading skills serves as the objectives. Having a framework to guide objectives, stop loss and take profit are essential trading tools for executing fund management plans. They are used to control financial risk and adjust the proper allocation of funds. It's like deploying troops on the battlefield. You can't just send them to the front lines and forget about them. Instead, you need to constantly adjust troops' movements according to changes in the situation. Stop loss is a method used to retreat from unfavorable situations to minimize losses, while take profit is a strategy employed to secure gains after achieving victory. When engaging in specific investments, the first step is to establish an investment plan. The overarching principle of the plan is fund management, which includes determining the overall investment ratio, the allocation of initial investment reserve funds and safety funds, adjusting the fund structure flexibly according to the market changes, and devising the details of funds management are essential to keep the funds in a secure state. In situations where the outcome is contrary to expectations, The first step is to determine the specific stop loss position and the amount of fund recovery. In the current scenario, implementing a stop gain repositioning requires a significant amount of fund recovery. For such methods, readers should continue to refer to relevant funds management practices. For instance, when encountering trends opposite to expectation, it's crucial to clarify the stop loss level and the amount of fund recovery. Similarly, in profitable situations, it's important to specify the stop gain levels and the amount of fund recovery, as well as whether there is a need to replenish positions after taking profits and the size of such replenishments and more. Over the past few days, we have focused on explaining professional knowledge related to fund management. It's not realistic to expect everyone to fully understand and memorize everything in a short period. Instead, our goal is to awaken everyone's professional trading awareness and help them recognize the gap between retail trading and professional trading. Therefore, it's essential to have the right conceptual understanding and gradually learn through repeated study and real world practice. In 2024, Jambi Institution launched a new partnership plan with retail investors called Wellstrom, aiming for a profile total target of 480% and above, divided into three stages. First stage is 100%, second stage is 280%, and the third stage is 480%. This trading plan signifies a long-term mutually beneficial partnership between Jambi Institution and individual investors aimed at expanding into the Indian investment market. The program progresses through three stages, starting with the first stage, which primarily involves accumulating funds through UC and BC trades to achieve wealth growth and prepare for the subsequent stages. The overall profit target is set above 480%. Jambi Institution will ensure that each stage meets its predetermined goals by sharing its trading privileges in the market. Currently, the first stage profit target of 100% has been achieved. Moving forward, we'll proceed to the second stage of operations. The profit target for the second stage is set at 280%. Therefore, it's crucial for everyone to strictly follow all instructions. This ensures the maximization of everyone's interest. Once again, a reminder to all, upon successfully obtaining IPO shares, you will be informed of the allocated quantity of shares and the amount due. Please ensure timely payment to avoid any penalties or the cancellation of your allocation eligibility. Additionally, payments for IPO shares can be made during weekends as well. Alright, currently our research team is in negotiations for block trade with an anticipated discount of around 30%. The initial timing is set for Monday. And once negotiations are finalized, I will instruct my assistant to notify everyone promptly. In the meantime, please ensure you have sufficient funds prepared, and you can also reach out to my assistant to reserve your share of the block trade. Be well prepared in advance so that we can seize the opportunity when it arises. No matter how murky the water may be, as long as it settles for long enough, it will become clear again. Similarly, no matter how foolish one may seem, with enough effort, they can still change their destiny. So let's conclude tonight's sharing here. Remember to reflect on the key points, as knowledge absorption isn't a one-time affair. Alright, that's it for tonight's sharing. See you next time. Good night. Take care.